Hi everybody, it's Rowan Smith from the Mortgage Center. I want to talk to you today about construction mortgages. A lot of people are looking at some raw land, lots available in the area, and they're thinking to themselves it'd be nice if they could buy the property, build the home they've always wanted and put it on there. And they're familiar with hearing the 5% down rules, that's the minimum down payment, and so they come and approach me and they want to get approval in those cases. It's usually not going to happen. The person who's putting 5% down, first off, 5% of what? 5% of the lot? 5% of the lot with the home, the end value, or 5% of the lot plus the construction costs. It depends what they're trying to do. Generally, if you're trying to do high ratio construction, that's anything where you're financing more than 80% of the cost of the property, you have to have enough income to service not only the debt but also your living expenses during the period of time. So most people that are building the homes for whatever reasons, whether it's tax efficient accounting or whatever, they rarely seem to have that income if they're trying to build a property. My experience is that most construction mortgages, you're going to need 35% of the end value in order for you to really get that construction deal done. So if a home's $1 million, you can look at having to put $350,000 of your own money into the deal. Now the way it works is you don't get to borrow $100, $200, $300, $400, $650,000 and then put your money in. It's not the way it works. The bank will always want your dollars in first. So what's going to happen is they're going to finance, say, 65% or 70% of the land. They'll advance dollars at that point. You'll put up some of your money. Then they'll say, okay, we've advanced. I'm going to grab a number here. Let's say the home's $1 million and the lot's $200,000. So they're going to give you 65% of $200,000 to start with. So $130,000. So you take that money, you've got to come up with the rest. So you're putting in the 70 of the $200,000 lot. Well, now what happens? You go and start your construction. The bank does not start advancing you the balance of the $650,000 that they're going to lend you. They make you put your money in first. So those initial construction costs are going to be yours, and you're going to cover them with your dollars. Once you've got the house to certain stages, at that point, the bank will start to advance you money. So at drywall, or at lockup rather, is usually the first stage, which is about 60%. Then there's at drywall, and then usually again at the end when the property is actually completed. It varies from institution to institution and what percentage point they're going to make you complete the home. And they'll have one of their appraisers come through and just kind of qualify it and say, yes, it's this much work is done. The remaining cost to complete is X amount of dollars, and the bank will then lend you and release money at that point. So you usually have to be well enough financed to come up with cash up front so that you can afford the construction costs and the labor trades, then get the money out at the end of the day. If you're thinking you're going to borrow the whole amount for construction, it's not going to happen. If you have anybody that's looking for construction loans, I can help kind of point them in the right direction and let them know if their estimate of costs and their budget and especially their capital usage and when it's going to be required is reasonable. Give me a call. I'm Rowan Smith for the Mortgage Center.